You know, in the world of major construction, risk is just everywhere. That's why today we're going to break down the essential safety net that protects these massive projects. We're talking about Clause 19 of the FIDIC Red Book 2017, the absolute master clause for insurance.
Just look at that number. $500 million. Imagine an investment that big. That's the kind of scale we're talking about for major infrastructure. And with stakes this high and so many moving parts, the potential for something to go catastrophically wrong is, well, it's immense.
So how in the world do you protect an investment of that magnitude? The answer isn't just one simple insurance policy. Oh no. It's a whole comprehensive framework. And that is exactly what FIDIC Clause 19 is designed to be.
So here's our game plan. We're going to look at why this clause is so vital, who's responsible for what, the specific policies you actually need, and then we'll wrap up with some really critical advice for making it all work in the real world.
Okay, first things first, you have to remember the context here. FIDIC contracts were made for huge international projects, the kind often financed by big players like the World Bank. In that arena, having standardized, reliable rules isn't just nice, it's absolutely paramount to give everyone involved a sense of security, no matter where on the planet the project is.
So how does this framework actually work in practice? Well, it all starts with Clause 19.1. This is the part that sets the stage by clearly defining who is responsible for what. It's all about creating a crystal clear chain of command for insurance right from day one.
FIDIC creates a really clear division of who does what. The default position is super simple. The contractor arranges all the insurance and the employer has to approve it. But, and this is a key exception, on those truly massive projects, the employer might step in and arrange the insurance themselves, just to use their scale and get better rates.
The whole procedure follows a very logical sequence. Step 1, the contractor proposes the policy. Step 2, the employer gives their consent. Once it's approved, the contractor pays up and hands over the proof. But here's the thing. This isn't a set it and forget it kind of deal. The contractor has a constant duty to keep the insurer in the loop as the project changes and evolves.
But what happens when things go wrong? Well, if a contractor fails to pay a premium, the employer has the right to step in, pay it, and then just recover the cost from the contractor. Now, this is a huge red flag. It often means the contractor is in financial trouble. A really smart safeguard is to make sure the insurer is required to tell both parties if a payment is missed. And ultimately, if one party's failure to keep up their end of the insurance bargain causes a loss, they have to pay the other party back for it. Simple as that.
Okay, so now we get the who and the how. Let's dive into the what. We're going to start with the specific insurance policies you need to protect the actual physical stuff on the project. First up is the main event, insurance for the works. This is your core all-risk policy. It's designed to protect pretty much everything being built. We're talking permanent structures, temporary buildings, materials, even the design documents, from any kind of loss or damage. Now, the details here are absolutely critical. The policy has to cover the full replacement cost, plus an extra 15% on top for any incidental fees. It has to be in place from the very start of the project, right up until the taking over certificate is issued, which is basically when the employer formally accepts the finished project. It even extends out to cover the contractor's work during that final defects period. Next up, we've got insurance for goods. Now, this policy is different. It's specifically for the contractor's own stuff, their machinery, their tools, and all the other items they bring to the site to get the job done. And it has to be insured for its full like-for-like replacement value. So the crucial point to get here is that this policy isn't static, it's dynamic. As the project starts to wind down, the contractor will naturally start removing their equipment. They have to tell the insurer about this so the policy coverage and, just as importantly, the premiums can be adjusted downwards. It's an active management process, not a one-and-done thing. All right, so we've covered protecting the physical assets, but the contract also demands protection against liability. So now we're going to look at the policies that safeguard the people involved and protect against any claims from third parties. This is a big one, professional indemnity insurance. It's there to cover the contractor if there are claims that their design just wasn't fit for purpose. But here's the all-important catch. This is only required if the contractor specifically gives the contractor design responsibility. If they're not designing anything, they don't need this policy. Next is your broad public liability coverage. This is the policy that insures against claims for death or injury to any person or damage to any property that might happen because of the construction work. It's really a fundamental protection against claims from the general public or other third parties. Of course, the workforce itself needs to be protected. This policy, which you might know as employer's liability, covers injury or sickness that affects any of the contractor's team. And what's really important is that this extends to subcontractor employees too, making sure every single person on that site is covered.
And here's something vital to remember. FIDIC doesn't operate in a vacuum. The contractor is always obligated to arrange any extra insurance that's required by local laws and regulations. And this often means getting separate policies that you really need to research thoroughly. All right, let's get to our final section. We've gone over all the rules, but what about the real world? Let's talk about the practical challenges of actually complying with all this and the best way to handle an insurance claim when, something actually happens.
Just listen to this. This is a powerful and honestly a pretty sobering warning that comes from the official guide to FIDIC itself. It highlights this incredibly dangerous gap between what the contract says should happen and what actually happens on the ground. You end up with a policy that exists on paper but is totally worthless when you need it most. So, why does this happen? Well, the source material points to situations where local contractors and even state employers, they just might not have the specialized expertise to really understand and properly vet a FIDIC compliance insurance policy. And the result? You get a policy that looks good, ticks all the boxes, but completely fails in practice. The lesson here is crystal clear. Expert, diligent review of every single term is absolutely non-negotiable.
So, if an incident does occur, how should you actually navigate the whole claims process? Following a really clear protocol is absolutely essential to protect the interests of both the employer and the contractor, and to make sure you get a fair outcome.
Okay, here are the best practices for handling a claim. First, control the money. Use a joint bank account for any payouts from the insurer. Second, notify them immediately. Third, and this is so critical, stick to the facts. Don't speculate, don't point fingers, don't assign blame. Just report what happened. Let the insurer do their job of figuring out the cause before anyone even starts talking about the value of the claim.
And that brings us to the final, critical question you have to ask yourself. Is your project's insurance policy a genuine, true safeguard that's protecting a massive investment? Or is it really just a box-ticking exercise? The answer to that question could truly make all the difference.